$7.4 billion vanished overnight. How did this happen? In the aftermath of Satyam's catastrophic financial collapse, the world watched as one of India's premier IT firms crumbled, leaving devastation in its wake. Investors lost fortunes, employees faced joblessness, and the reputation of an entire industry was irreparably tarnished. Once celebrated as a paragon of success in India's booming tech landscape, Satyam's downfall starkly illustrates the dangerous normalization of unrealistic financial reporting. Executives consciously chose deception over transparency, inflating revenues to meet market expectations, fueled by a toxic corporate culture prioritizing short-term gains. This fatal decision was rooted in a pervasive operational psychology where maintaining an illusion of growth overshadowed ethical business practices. Satyam's rise showcased significant financial growth and prestigious clientele, creating a facade of infallibility. Investors and stakeholders placed their trust in a company that seemed like a beacon of prosperity, yet the seeds of deceit began sprouting amidst this apparent success. Complacency permeated the organization. As the hype escalated, warning signs emerged unnoticed. Discrepancies between reported profits and actual cash flow began to surface, yet they were ignored. Auditor reports highlighting these inconsistencies vanished into a void of corporate reassurance. The initial momentum of inflated earnings masked impending disaster. Executives celebrated their results, basking in accolades while the company's operational health deteriorated underneath. The first signs of risk were trivialized, shrouded by a culture that exalted achievement at any cost. As the deception grew, so did the operational inefficiencies that would eventually trigger a liquidity crisis. In a twist of fate, a whistleblower emerged, unveiling the hidden discrepancies that had long been buried beneath layers of falsified documents and comforting lies. This pivotal moment ignited investigations that laid bare the stark reality of Satyam's fraud. $7.4 billion in fabricated revenue. Panic spread as the truth unraveled, triggering a downward spiral of consequences. Satyam filed for bankruptcy. Shares plummeted, and with them, the trust built over years evaporated within days. The aftermath was as dire as the collapse itself. Legal repercussions followed swiftly. Key executives were imprisoned, while the fallout negatively impacted thousands of employees and investors alike. Families faced financial ruin, businesses shuttered, and confidence in Indian markets sharply declined. The repercussions rippled across the globe, exposing severe flaws in corporate governance that transcended national boundaries. In the wake of Satyam's catastrophic demise, regulatory reforms were initiated, leading to heightened scrutiny in financial reporting practices and corporate governance. New oversight mechanisms emerged with the intent to prevent similar scandals from recurring in the future. Trust, once shattered, became a currency in dire need of restoration. The narrative surrounding Satyam serves as an enduring lesson. It underscores the critical need for transparency in financial reporting, the dangers of complacency in corporate governance, and the imperative for accountability. As organizations evolve and grow, it is crucial to remember that sound ethics and honest practices are fundamental to sustained success. Without them, the costs are devastating, not just in financial terms, but in the very trust that sustains the fabric of our markets and communities.